Hi there, it's Friday the 27th of March 2020. I'm Steve Towers. Welcome to ITB. Let's get started. Many governments continue to announce significant economic support packages in response to the economic crisis caused by COVID-19. The support packages generally involve a deferral of income tax and/or VAT payments for both individuals and companies, and sometimes a reduction in certain VAT rates. And some countries have announced substantive tax law changes impacting companies. Three notable examples this week are the US, Russia, and Kenya. I'll deal with each of these in turn. The US Senate has passed a $2 trillion tax and spending bill, the CARES Act. Today, Friday, it will likely be passed by the House of Representatives, and President Trump has indicated that he will sign it immediately. I've noted three substantive corporate tax changes. Firstly, net operating losses arising in 2018, 2019, and 2020 will be able to be carried back to the 5 prior tax years for deduction against 100% of taxable income in those prior years, thus generating tax refunds. Secondly, the limitation on interest deductions in Section 163J, which is currently set at 30% of adjusted taxable income, will be increased to 50% of adjusted taxable income for 2019 and 2020. And thirdly, companies with remaining AMT credits will be able to accelerate their utilisation, thus generating tax refunds. In Russia, the government has announced a proposal to amend Russia's double tax treaties to enable the 15% domestic law withholding tax rate on outbound dividends to fully apply. This was first announced in a national address by President Putin on Wednesday and was confirmed by the Prime Minister in a meeting on Thursday. Both leaders indicated that if a treaty partner did not agree with the amendment, Russia would terminate the treaty. This is what the two leaders said on this issue. I won't read out these two passages. Please hit the pause button to study them. And in Kenya, the government has announced that the corporate income tax rate will be reduced from 30% to 25%. It also announced a reduction in the standard rate of VAT from 16% to 14%. Meanwhile, the OECD has issued a number of items of guidance for governments to consider in designing their support packages. I've listed them here. For a copy of these documents, please go to our website or app. And in the EU, ECOFIN has agreed to temporarily relax the rules which limit government deficits in member states. For a copy of the press release on this topic, please go to our website or app. In Turkey, the government has issued final guidance on the country's 7.5% digital services tax, which entered into force on the 1st of March. This guidance was released in draft form on the 5th of February. There are no significant differences between the draft and final versions of the guidance in regard to the scope of the DST. For a copy of the final guidance, please go to our website or app. In France, the tax authorities have released for public comment draft guidance in regard to the country's 3% DST. Public comments are requested by the 23rd of May. For a copy of the draft guidance, please go to our website or app. The OECD has released its second peer review report on BEPS Action 6, which deals with the prevention of treaty shopping. The report includes the aggregate results of the performance of all 129 jurisdictions which were members of the Inclusive Framework on the 30th of June 2019. For a copy of the report, please go to our website or app. And due to the business disruption being caused by COVID-19, the OECD has announced the deferral of the deadline for public comments on the public consultation document concerning reporting rules for platform operators. The deadline has been deferred from the 20th of March to the 13th of April. In Australia, the tax authorities have issued updated guidance on the interpretation of Australia's double tax treaties. Amongst other things, the update covers recent court decisions. For example, the Chevron case on Article 9 and the Satium case on deemed source are both included in the amendments. For a copy of the updated guidance, please go to our website or app. Also in Australia, the tax authorities have issued guidance in regard to the valuation of debt capital for thin capitalisation purposes. For a copy of the guidance, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided an interesting case in regard to domestic law source rules and the other income article in the India-US Treaty. An Indian company, which was a member of the Volkswagen Group, conducted a major product launch event for a new model of the Audi motor vehicle. The product launch event occurred in Dubai. However, the event was totally focused on the Indian market for Audi vehicles. For example, the event was attended by 150 India-based customers and media representatives. The Indian company had no existing or proposed business operations in the UAE. A key aspect of the event was the personal appearance by Nicolas Cage, the US actor. His appearance was arranged by payment of an appearance fee by the Indian company to a US resident company. The issue in the case was whether the appearance fee was taxable in India under domestic law and under the India-US Treaty. The tribunal held that the appearance fee was derived through a business connection in India due to the focus of the event on the Indian market. The fee was therefore deemed to accrue or arise in India and was thus taxable in India under domestic law. A number of commentators in India have expressed surprise at this conclusion, on the basis that it seems to conflict with long-standing case law. In regard to the India-US Treaty, the tribunal held that none of the specific articles applied. In particular, Article 18, which deals with entertainers, did not apply because it is limited to activities performed in a contracting state. The tribunal therefore held that Article 23(3) applies, which allows India an unlimited right to impose tax on the fee. Article 23(3) is in essentially the same form as Article 21(3) of the UN Model Treaty. It says this: notwithstanding the provisions of paragraphs 1 and 2 of Article 23, items of income of a resident of a contracting state not dealt with in the foregoing articles of this convention and arising in the other contracting state may also be taxed in that other state. As I've noted on several occasions in ITB, Article 21.3 of the UN model is dangerous in the hands of an aggressive tax authority, or in this case, in the hands of an aggressive tax tribunal. If the business profits article is applied in a narrow way, Article 21.3 can be interpreted as applying to items of business income, even though the taxpayer has no PE in the source country. And that appears to have happened in this case. The tribunal's decision does not even mention the business profits article, Article 7. It moves directly from Article 18 to Article 23.3. For a copy of this case, please go to our website or app. Also in India, the GST Council held its most recent meeting last week. The most significant change concerns GST rates. Notably, the GST rate for mobile phones and specified parts will be increased from 12% to 18%. The GST Council issued 3 press releases after this meeting. For a copy of the press releases, please go to our website or app. In Taiwan, the Ministry of Finance has issued guidance on the offshore profits repatriation regime, which operates for 2 years from the 15th of August 2019. For a copy of the guidance, please go to our website or app. The European Commission has published a draft agreement which is intended to form the basis for discussions with the UK on the post-Brexit relationship between the EU and the UK. For a copy of the draft agreement, please go to our website or app. In France, the government has published a notice which specifies the requirements for the DAX 6 return regarding reportable cross-border arrangements. For a copy of the notice, please go to our website or app. Also in France, the tax authorities have issued, for public comment, draft guidance in regard to the VAT obligations which have been placed on online platforms effective the 1st of January 2020. Public comments are requested by the 31st of May. For a copy of the draft guidance, please go to our website or app. In the Netherlands, the government has issued a decree which amends the law in regard to the participation exemption, effective the 19th of March 2020. For a copy of the decree, please go to our website or app. In Sweden, the Supreme Administrative Court has decided a free movement of capital case in regard to dividends paid to a US regulated investment company. You'll remember that I have covered 2 similar cases late last year. One decided by the Spanish Supreme Court and the other decided by the European Court of Justice. The US RIC owned shares in Swedish companies. The Swedish companies paid dividends to the US RIC and deducted dividend withholding tax in accordance with the Sweden-US Treaty. The US RIC argued that the imposition of the dividend withholding tax breached the free movement of capital, which is required by Article 63 of the Treaty on the Functioning of the European Union. For that purpose, it argued that its position should be compared with a hypothetical Swedish contractual investment fund, holding shares in Swedish companies. At the relevant time, a Swedish contractual investment fund was able to reduce its Swedish tax base by deducting the dividends it distributed to its investors. However, under the Swedish tax law, the US RIC was not entitled to deduct dividends it distributes to its investors. That difference in treatment, said the US RIC, breaches the free movement of capital, and therefore the US RIC claimed a refund of the withholding tax. A threshold issue was considered by the Supreme Court. Can the US RIC and the Swedish Contractual Investment Fund be compared for this purpose, having regard to the fact that the US RIC is a separate legal entity, whereas the Swedish Contractual Investment Fund is not? The court held that that particular difference was not sufficient to mean that the two cannot be compared. It therefore sent the case back to the lower court to make the comparison for the purposes of the free movement of capital. Also in Sweden, the tax authorities have issued guidance in regard to the tax treatment of negative interest, which is charged by banks to companies. For a copy of the guidance, please go to our website or app. In the UK, the tax authorities have launched a public consultation on ways to raise standards and increase transparency in the tax advice market. The consultation will run to the 28th of May. For a copy of the consultation document, please go to our website or app. In Nigeria, the Tax Appeal Tribunal has decided another case in regard to the so-called excess dividends tax under Section 19 of the Companies Income Tax Act. You'll remember that I covered other cases on Section 19 last year. This recent case also concerns a situation where a Nigerian company derived income which is exempt from Nigerian income tax. It then paid a dividend from that income, and because the dividend exceeded its taxable profits, it was assessed for excess dividends tax. The tribunal agreed with the tax authorities, a decision which is in line with recent decisions on Section 19. You might also remember that this particular aspect of Section 19, that it applies in situations where a dividend is paid out of exempt income, has been removed in the Finance Act 2019, effective the 1st of January 2020. In South Africa, the tax authorities have issued for public comment draft guidance in regard to interest withholding tax. Public comments are requested by the 29th of May. For a copy of the draft guidance, please go to our website or app. Also in South Africa, the tax authorities have issued updated guidance on the limitation of capital allowances granted to lessors of so-called affected assets. For a copy of the guidance, please go to our website or app. And finally, in South Africa, the tax authorities have issued guidance on the mutual agreement procedure under treaties. For a copy of the guidance, please go to our website or app. In the UAE, the Dubai International Finance Centre has issued guidance on the UAE's economic substance regulations in regard to DIFC firms. For a copy of the guidance, please go to our website or app. In Canada, the Supreme Court has decided a threshold issue in a class action litigation against Amazon for damages for incorrectly charging GST and provincial sales tax. The court decided the threshold issue in favour of the claimants, which means that the litigation can now proceed. In Peru, the tax authorities have issued guidance on the effect of transfer pricing adjustments for VAT purposes. For a copy of the guidance, please go to our website or app. In the US, the Treasury and IRS have issued final regulations under Section 901M on covered asset acquisitions, which generally limits foreign tax credits. For a copy of the final regs, please go to our website or app. And also in the US, the IRS has released 2 private letter rulings in regard to REITs. For a copy of the 2 rulings, please go to our website or app. And this has been a very slow week for treaty developments. All we've had is one protocol enter into force. I have 2 articles for you this week. The first article is called European Union VAT Fixed Establishments in 2020, a Call to Action. It's written by Joachim Zutt and Bas Gunther, and it's published in the IBFD's Derivatives and Financial Instruments Journal. This article discusses 2 pending referrals to the European Court of Justice regarding the VAT treatment of transactions carried out by fixed establishments, and in particular, the right to input tax credits. Those 2 cases are Danske Bank on referral from Sweden and Bank of China on referral from France. The article discusses these 2 cases in the context of 2 relatively recent ECJ cases concerning VAT and fixed establishments, Scandia in 2014 and Morgan Stanley in 2019. The second article is called Constructive Dialogue, BEPS and the TCJA. It's written by Reuven Avi-Yonah and it's available on the SSRN website. For a copy of this article, please go to our website or app. The abstract to this article says this: US international tax law is commonly conceived as developed in the US and influencing the development of other countries' international tax law. This paper will argue that in the case of the TCJA, that is, the 2017 US tax reform legislation, the US legislation was heavily influenced by the OECD BEPS project, and that the continuing work in Pillars 1 and 2 is likely to have a similar influence on the future development of US international tax law. Well, that's the way it is this Friday, the 27th of March, 2020. I'm Steve Towers. Have a great weekend.